India, the world's largest democracy, stands at a critical juncture. Despite recent glimmers of hope, such as cooling inflation and a proactive central bank, high unemployment and mounting government debt loom large. The unemployment rate stood at a worrisome 8% in November 2024. Simultaneously, the government's debt-to-GDP ratio is projected to reach 87.5% by the end of 2024. These interconnected challenges demand immediate attention and decisive action. Failure to address them could have far-reaching consequences for both India and the global economy. At the heart of India's economic woes lies a persistent and growing unemployment crisis that has been affecting millions. With a staggering 8% unemployment rate recorded in November 2024, the situation is dire. Millions of Indians, particularly the youth, find themselves locked out of the job market, struggling to find opportunities. Structural issues within the Indian economy, such as a lack of adequate education and skills training, are significant barriers. Coupled with a slow pace of job creation in key sectors, these issues have exacerbated the problem, making it more complex. The COVID-19 pandemic further compounded these challenges, leading to widespread job losses and business closures, particularly in the informal sector. For individuals, unemployment translates to lost income, diminished opportunities, and a sense of hopelessness that can be overwhelming. On a broader societal level, high unemployment can lead to social unrest, crime, and a decline in overall well-being, affecting everyone. Short-term measures could include expanding existing social safety nets and providing targeted employment programs to those in need. Sustainable solutions lie in investing in education and skills development, fostering entrepreneurship and innovation. Creating a more conducive environment for job creation in the formal sector is essential for long-term growth. Adding to India's economic woes is the rapidly rising government debt, a ticking time bomb that threatens to destabilize the entire economy and create widespread financial turmoil. With a debt-to-GDP ratio projected to reach 87.5% by the end of 2024, India faces a perilous fiscal situation that could have long-lasting impacts. The government's increased borrowing to finance social welfare programs, infrastructure projects, and stimulus packages, coupled with a decline in revenue collection due to the pandemic-induced economic slowdown, has widened the fiscal deficit significantly. This, in turn, has led to a surge in government debt, creating additional financial strain. High debt levels can crowd out private investment as the government competes with the private sector for limited funds, stifling innovation and economic growth, which are crucial for the country's future. The government must prioritize expenditure, focusing on essential services and investments with high economic returns. Simultaneously, it needs to enhance revenue collection by broadening the tax base and improving tax administration to ensure fiscal stability. Amidst the gloom of unemployment and debt, there is a glimmer of hope on the inflation front. Retail inflation has shown signs of cooling down, reaching a 5-year low of 3.34% in March 2025. Easing food prices, driven by favorable monsoon forecasts and improved supply chain conditions, have played a significant role. Additionally, softening global commodity prices and a slight appreciation of the Indian rupee have also contributed to the downward trend. This cooling inflation brings several potential benefits. It eases the burden on consumers, particularly low-income households, who are most vulnerable to price fluctuations. It creates room for the Reserve Bank of India to maintain an accommodative monetary policy stance, keeping interest rates low to stimulate economic activity. The Reserve Bank of India, India's central bank, faces a delicate balancing act as it navigates the treacherous waters of the country's economic turmoil. In April 2025, the RBI announced a 25 basis point cut in the repo rate, bringing it down to 6%. This marked the second consecutive rate cut, signaling the central bank's commitment to stimulating economic activity and boosting credit growth. However, the RBI's accommodative stance comes with its own set of risks. Lower interest rates, while intended to boost investment and consumption, can also fuel inflation if not managed carefully. The RBI must strike a delicate balance between supporting growth and keeping inflation in check. Lower interest rates make it cheaper for businesses to borrow and invest, potentially leading to increased production, job creation, and economic growth. Addressing India's complex economic challenges requires a comprehensive and well-coordinated policy response. Short-term measures. Boosting aggregate demand. The government can stimulate demand through increased public spending on infrastructure projects, social welfare programs, and tax cuts for businesses and individuals. These measures can help revive economic activity and create jobs, providing targeted support to vulnerable sectors. Specific sectors hit hard by the pandemic, such as tourism and hospitality, require targeted support measures including tax breaks, loan guarantees, and subsidies. This will help them recover faster and sustain operations. Strengthening the social safety net, expanding existing social safety net programs such as direct cash transfers, unemployment benefits, and subsidized food rations is crucial. Long-term structural reforms, investing in education and skills development. A skilled workforce is essential for attracting investment, fostering innovation, and driving economic growth. This includes improving access to quality education and vocational training, promoting entrepreneurship and innovation. Encouraging entrepreneurship and fostering a culture of innovation are crucial for creating new jobs, boosting productivity, and driving economic growth. Support for startups and small businesses is vital. Improving infrastructure. Efficient and reliable infrastructure is the backbone of a strong economy. Investments in transportation, energy, and digital infrastructure are necessary. Fiscal consolidation and debt management. Addressing the rising government debt requires a multi-pronged approach, including rationalizing expenditures, broadening the tax base, improving tax administration, and exploring innovative debt management strategies. This will ensure long-term fiscal sustainability. India stands at a crossroads, facing significant economic challenges that demand urgent attention and decisive action. The issues of high unemployment, mounting debt, and sluggish growth threaten to derail the country's progress and undermine its hard-won economic gains. However, amidst these challenges lies an opportunity for transformation. By embracing bold and innovative policy solutions, India can overcome these hurdles and emerge stronger, more resilient, and more prosperous. This requires a collective effort from all stakeholders, including the government, the private sector, and civil society. The need for action is now. By implementing the policy recommendations outlined above, India can chart a course toward a brighter and more equitable future for all its citizens. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.